Good morning. My name is ADITYA PATTANAIK. I'm an investment advisor at Sprott. The following excerpts are from a discussion I recorded with Rick Rule on the 10th of July, 2023. The object of these discussions is to highlight certain features and specific idiosyncrasies of the resource market from the point of view of a seasoned and successful resource investor. That may help you stay the course if you are invested and buy bottoms if you're not. I start the discussion by asking Rick about his general thoughts on the absence of institutional interest and fund flows in many segments of the resource market based on strong narratives and low valuations in this group relative to other segments of the market, despite the prevalence of ample liquidity on the sidelines and more recently in specific segments of the primary market.
I remember myself coming of age in the decade of the 1970s, and the period of 1970 to 1981, with the exception of 1975, was an epic romp in natural resources. And it gave rise to a belief, a Malthusian belief, that the world was going to run out of natural resources. The fact that the price activity in the 1970s supported that narrative meant that narrative assumed dominant sort of status relative to any other economic narrative. And that trend was in motion until it was over. I suggest that investors pay attention both to the arithmetic around this narrative, but also to arithmetic that's bullish as well. I am not suggesting that your clients, as an example, ADITYA, put all of their net worth into natural resources and precious metals. I'm only suggesting that your clients pay attention to possibilities, probabilities, and reversion to mean. We talked about breadth in the general equities market and the fact that breadth was very much constrained to the top sort of 12 to 20 mega cap world dominating technology companies. I'm not suggesting for a second that those aren't good businesses, ADITYA, and I'm not suggesting that they won't continue to be good businesses. I don't know enough about technology to know whether they're appropriately priced or not, so that I don't own them. But to the extent that people in your book believe that they do understand how to value them, and to the extent that they believe that those are reasonable valuations, I certainly wouldn't discourage people from owning them. But I think that in any form of reversion to mean, that extractive industries will do well. While the share price around resource companies has been at best treading water for the last 2 or 3 years, when you look at the performance of the mining mega caps, the Glencores, the BHPs, the Rios of the world, what you'll see is really pretty good corporate performance that has been less well reflected in the equities market, perhaps because of investor experience with regards to poor capital deployment in extractive industries over 15 or 20 years, or partially, perhaps, as a reflection of investors' concerns about what they see as an impending recession. So I know that there is a tendency of investors who are younger than I, which now means almost every investor on the planet, to believe that a year or two are relevant timeframes. They aren't. And I think that investors who are paying attention to themes like systemic underinvestment in oil and gas productive capacity, or the electrification of humankind, need to understand that those themes necessarily take years and years and years to play out. And investors need to steel themselves for volatility, for cyclicality, for recessions. and they need to right size their portfolios, both in terms of their psychological, but also their financial needs. The asset class, the only asset class that I, as a long-term investor, am really terrified of are long bonds. I really believe that the bond bubble that was built up over 40 years of benign economic climb hit the most ludicrous proportions of any market bubble that I've seen in my life. The idea that Argentina, as an example, is a serial defaulter, 9 defaults, was able to get off like a 50-year bond, just absolutely astonishes me. And I'm sorry for this sort of broad soliloquy, but you asked a question that I think was posited on the fact that events that seem probable have not been playing out in the market. And as a consequence of that, investors' patience is wearing thin. My experience, as I say, over time has been that these very trends take time to play. And by the way, when the price action has really hyper justified the narrative so that you become completely confident in the narrative, it's probably time to begin to think about selling.
I want to come back to the spirit of this discussion, which is how you think about the performance of asset classes that you hold, particularly if they are underperforming your expectations over several years. I'd like to start with the precious metals sector. So the performance, and I'm looking at this from the point of view of the precious metals complex as a whole. So this includes gold, silver, and the precious metal miners. On the one hand, the macro environment seemed tailor-made for higher gold and silver prices, at least up until the Fed started raising interest rates. Central banks were buying gold at historic levels. Individual investors in places like India were buying silver in record amounts. But institutional investors have been missing from the equation. And when you look at the ETFs and the miners, there's significant outflows from these two categories. Now, I've seen a number of charts where the volumes on the TSX Venture Exchange, which is mostly made up of resource stocks, are close to the levels that they were at in 2015 and in 2018, which were the last two bottoms in the precious metal sector. So I'd like to get your thoughts on how you think about the performance of the precious metals complex based on the current macro environment, and whether it changes your expectations for this group in any way.
I note, by the way, that you prefaced the question by saying that the volumes on the TSXV correlated with market bottoms. And I would encourage speculators to come around to the point of view that buying bottoms is a good thing. I realize it's hard to do, but it's necessary nonetheless. Despite the fact that rationally I wouldn't need to own any gold at all because I'm a very large shareholder of Sprott, and if the gold price does well, theoretically Sprott should do well. I am content buying gold because I've learned over 50 years, and also by studying history, that gold traditionally has been an asset class that does well when things aren't going well. And I think that the expectation of things not going well has been diminished, as I've said before, by 40 years of benign economic climate and of the teaching as a consequence of that. I need to say that I have been pleasantly surprised that the gold price in particular is held up in the face of rising interest rates. Pleasantly surprised because I think that consumer confidence is fairly high, unreasonably high from my point of view. And gold did what I asked it to do. With regards to the gold equities markets as expressed by the XAU, they have been disappointing to me. If ADITYA, your clients were to review the chart, the gold stock chart that you and I used to talk about so often in exercises like these, the understanding of the way that that market works, the understanding of the cyclicality, but also of the volatility, the understanding that doing well, doing poorly, doing well again, and then doing spectacularly well is the reality of the market, looking back for a very, very long time. If investors are looking for certainty, I'm tempted to quote someone whose name I can't remember that says the only things that's certain are death and taxes, neither of which I look forward to. But predictability around markets and predictability too around probabilities, like the debasement of the currency ultimately will lead to higher gold prices. Buying market bottoms is good. And the fact that if the probability is uncertainty around the maintenance of purchasing power in the gold, that gold stocks ultimately will outperform gold. While none of these is a certainty, I would argue with you that all of them are probabilities. And I would argue that a review, not of the fundamentals so much, but a review of history, as was evidenced by that chart that you and I used to talk around so much, is probably in order.
If you look at things from a cause and effect point of view, a lot of the causes that we've talked about over the last few years have actually manifested themselves for a stronger precious metals equities market. The effects have been different, and as someone trying to justify patience, and I suppose you said it in other words, thinking in probabilities and being patient.
I think that you need to live your life accepting an imprecise view of the future, that you need to organize your portfolio, your education, everything about your life in anticipation of probabilities. I think that while that might be unsettling to some, you need to adjust yourself to a realistic point of view of the world, ADITYA. I'm struck again with your returning to the patience theme, which I think is probably the most important theme that we're discussing today, patience and right sizing. Buffett famously said that the market is a great mechanism for transferring money from the impatient to the patient. I noticed myself that I'm consistently 2 or 3 years too early. And I need to say somewhat immodestly that being 2 or 3 years early is probably responsible for making and keeping me rich. I would say finally to the speculators, and I suspect that you have a lot of speculators in your book of business, that the activity for which I became well known, which was really speculation, the searching not for market beta, but rather for market alpha. If you define success in speculation as achieving 1,000% gains, 10 baggers or 20 baggers, we've talked about this before. We backtested most of my successful, and by the way, many of my unsuccessful trades going back 40 years. And if you segregate for 10 baggers, or better, the average 10 bagger took between 5 and 6 years to generate that 1,000% gain. And in the course of the 5 or 6 year holding period, perturbations, that is to say, volatility, 15% declines, 20% advances, 25% declines, were numerous. But more importantly, most of my 10 baggers exposed me to 50% share price declines in my personal portfolio in that position during the period of time that I held the stock. You need to be not merely patient, but persistent if you're going to be a speculator, or else you will not succeed. Let's look at one case, Equinox. I've invested with Ross Beatty since, if my memory serves me well, 1987. No, earlier than that, 1984. It doesn't matter, a long time. And I've had an awful lot of success with him. That success has never actually been tempered by failure. It's had some that were less successful than others, but a real track record of success. And all those successes have taken time, and they've all caused me to experience trauma. In one of the most recent offerings, Equinox, the stock is off 60% or so in 12 to 18 months. One must ask oneself, in the face of a 50% decline, why? Were your assumptions wrong? I think that the stock fell for 3 reasons, perhaps 4. One, lack of attention from Ross himself. The second was underinvestment in sustaining capital at Mesquite. The third was social and political disruption in Mexico. But far and away, the most important was the market's anticipation of failure at Hard Rock, not based so much on Equinox, but based on the recent industry experience of having trouble completing large underground mines in northern Ontario. It is my bet, I'm a large shareholder, that they will in fact develop and deliver Hard Rock on time, on budget, and at nameplate capacity. If they do, the $1 billion in cash that's gone out, as well as the market apprehension, will evaporate. And cash will begin to come back in. You'll begin to see cash escalate quarter by quarter on the balance sheet, the same way that it did when they built and or bought their Mexican assets. And the consequence of that is that the hard times around Hard Rock, if you will have been a thing in the past, and that the stock will produce for me the same way that other Ross Beatty names have in the past. Being able and willing to speculate in a name like that, perhaps it involves having been a professional investor in the space for a very long time, having watched Ross Beatty for a very long time, and having experienced both trauma and success with him over a very long time. That notwithstanding, the process by which you analyze share price performance and you account for share price performance and think about the probabilities of various actions in the future and how they might impact share prices is precisely the process that you need to do to succeed in the sector, or any sector, I would suggest.
I think Equinox is really interesting in the sense that if you look at this company from a point of view of the income statement or the balance sheet, and we've talked about book value and we've talked about earnings previously, you would come to a slightly different conclusion than if you look at it from the point of view of net present value and future potential and adult supervision.
Well, book value is often problematic in the mining industry. A mine that is a very high quality mine that didn't require as much upfront capital, as an example, and was discovered rather than bought, could have a very low book value, but in that case would generate a very high return on capital employed. I agree with you that there is a variability in net present value that's uncomfortable. I would only suggest that net present value is, over time, a more useful metric, certainly, than book value. Companies that are selling at a large discount to book, as an example, are often companies that have delivered a low net present value relative to the acquisition cost and the development cost of their producing assets. Similarly, EBIT, cash flow, and earnings, while they're important to the market, are somewhat illusory in the sense that if you are valuing a company on a price earnings basis or a price EBIT basis or a price free cash flow basis, you assign the same valuation to a company with 3 years of remaining cash flow as you would for 10 or 12 years of remaining cash flow. Fairly clearly, the ability to generate cash over a decade is of greater interest to investors than the ability to generate cash over only 2 or 3 years. And I get, again, for that reason, while net present value isn't necessarily, well, isn't close to a perfect measure, it has the advantage of being, I think, the best measure that there is.
Okay, I want to talk about silver equities. And again, this question is not intended as an investment recommendation for anyone, but it's more so to get a sense for how you view the performance of a company through the lens of the share price of their company over a few years. When I look at Silvercrest, over the last 3 years, they have progressed their project through various economic studies. They've financed the project, they've built it, and they've achieved commercial production. The share price chart of Silvercrest has followed the rest of the sector over the last 3 years, and the enterprise value is approximately 40% lower than where it was in August of 2020. Now, if I look at it from a P/NAV basis based on their feasibility study, Silvercrest is trading close to around 1 times NAV based on the assumptions that they used a few years ago. Now, at higher silver prices, all these numbers, of course, start looking very different, and Silvercrest probably appears a lot cheaper than it is today. But I was interested in how you interpret this 40% decline, as they have seemingly delivered on all regards. Do you view them as being fairly priced, or do you view this as more an idiosyncrasy of the markets right now?
Very much the latter. I think this is not investment recommendation because other people's patience, means, and needs are different than mine. But I think the weakness in Silvercrest is explained really by 3 phenomena. The first is that at the beginning of the time that you measure, which is to say, when Silvercrest was, at least in terms of its price, at its peak, was a point in time when silver and the silver equities were decidedly more in favor than they are today. 2, the Silvercrest management team was enjoying a bit of a halo because they had had a prior success where they made a nice discovery and sold it and had a monetization. And I think the market was looking, rather than for Silvercrest to go into production, for Silvercrest to pretend to go into production and, in fact, to sell. I think the Silvercrest management team would have been happy to do that, but they didn't receive a bid that, in the context of the market that existed then, interested them. I do think, as a consequence of on time, on budget completion, that when, as, and if they reach nameplate capacity, both in terms of tonnage, but also in terms of AISC, that either the market will reward them for the certainty associated with nameplate completion, or they'll be taken over.
I want to touch on uranium as well. Unlike the silver equities market, the performance of the uranium equities has actually been quite varied across the landscape of equities, particularly over the last 2 years. Interestingly, the largest names like Cameco have actually held up a lot better than most other names in the sector, particularly the junior end of the pack, with a few notable exceptions. There've also been a lot of new junior uranium exploration companies that have come into existence over this period. When we were talking about a reasonable price assumption for uranium 3 years ago, $50 per pound seemed like an aspirational long-term target. Today we're sitting at around $56 per pound, so we've already exceeded that target. Now, when I look at Kazatomprom at $43 a pound, which was their realized price in 2022, they have an operating margin of 40%. So the largest name in the sector operates at a 40% margin at $43 per pound. The better quality development projects are using $60 to $65 per pound in their studies today, and the more marginal projects are currently calculating NPVs at around $75 per pound. So there is the spot market, which seems a lot more dependent on activity levels of the financial players. The number of these players also seems to be growing. And then there's the term market, where different companies today seem to be attracting a wide range of prices based on the contracts that they're signing. So in your opinion, and this is from the point of view of setting an upper bound for a price to use to discount uranium equities, do you think it is the most marginal pound that drives the discount price, or do you think it is the price activity in the spot market, which is what we saw in 2021, which seemed to be the driver of uranium equities?
I think the valuation metrics vary, to be honest. I think you're seeing a market that's in transition. As recently as 3 years ago, probably 80% of the transactions took place in the spot market. Now you're seeing the term market become much more important. And that transition from spot to term, which I don't think has been absorbed by the investment market very well, has some fairly profound impacts on producers. The most important of which is that in the term market, generally, you have price protection to the downside, and the utilities have price protection to the upside. And what that means is that, as an example, a producer like Cameco or Kazatomprom, with a sufficiently robust term contract and counterparty, can know with some degree of certainty within a range what level of revenues they're going to have for a 5-year term, a 6-year term, sometimes even a 10-year term. And what that means is that a company like either of those two that have substantial shut-in production can understand fairly well the set of circumstances with regards to contracted volumes and price, which will allow those projects to restart. They don't have to go through the permitting. They don't have to go through construction. They don't have to go through anything. They just have to take what is called a hot shutdown, which is to say a project that isn't currently producing, but has been very well maintained. And when they have sufficient volumes contracted at a sufficient price that they meet their margin targets, their return on capital employed targets, they can restart the deposit. The valuation metrics with regards to pricing for juniors are very different, particularly if the juniors have conditioned their investors to think in terms of spot, because putting a mine into production, absent some long-term contracts, given the variability in uranium prices that we've seen over the last 15 years, gives lenders pause. And I think what you're beginning to see is a 2 or 3 tiered market, which is to say the investment community will assign Cameco in particular a reasonable amount of certainty in terms of valuations at a $55 or $60 price. But they won't use anywhere near that level of certainty, even in high quality development names, the next gens, the fissions, because the projects have yet to be financed. and they have yet to have a sort of they don't have enough visibility in terms of their revenue streams. The investors, if that's the right phrase, in many of the juniors liked the juniors for optionality, which is to say, there are a lot of investors who remember well the bull market in uranium that occurred in 2000 to 2006, 2007. And what those speculators are looking for is upside in the uranium price. And oddly, that means that the management teams of many juniors are being actively discouraged from locking in the sort of contracts which would enable their reserves to be developed and put into production, because those long-term upsides, long-term contracts, pardon me, while providing certainty in terms of downside, reduce some of the upside. And I think it's fair to say that some of the speculators are much more near-term share price focused than they are long-term value focused. I'm not myself certain how this will resolve itself. And I suspect that the valuation discrepancy will continue. I think with the tertiary names, that is to say, with the names of explorers who have some resource but haven't been able to convert it to reserve, they will continue to be challenged by disintermediation from themselves to even more speculative names, pure explorers, because that constituency is very much upside and narrative oriented and very much less net present value oriented. So it may be that you end up with three segregated capital markets in the uranium space. I don't know that this will be the case, but I'm seeing signs that that emerges.
It's interesting that this was not the case when we started off the rally in the equities in 2021.
Well, you make a good point. That was a speculative rally. That was the first bull market in resources, by the way, that I've ever seen that didn't begin with the best players and move down the quality chain. It began with the worst players and moved up the quality chain. What I have seen for the last 50 years in commodity producer markets is that traditionally the first market to move is the market for the physical commodity itself. The second part of the market to move is the companies that are the most immediately impacted, which is to say the companies with large existing producing bases, particularly producing bases that provide a little bit of downside support and immediate cash flow increases commensurate with the increase in commodity price. The next part to move would be established producers, but established producers that are not yet of top quality. Traditionally, the next sector to move are the potential takeover targets, then the developers, then the explorers. In this case, the case with regards to the uranium equities, there was an immediate move in the small market cap explorcos, whether or not they had reserves and resources. And the increase in equity prices that I observed, at least, moved in backwards fashion from the gamiest names eventually to the most secure names. I haven't seen a bull market like that before.